Good afternoon, ladies and gentlemen. A warm welcome to all of you to the 6th Annual Investor Forum of Nations Trust. Thank you all for being here. Let me begin by giving the context to this presentation and recapping a little bit as to where we are today and actually who we are. So, in our team, in our bank, what inspires us daily is our vision and our purpose, which is to help people and businesses achieve today's goals and tomorrow's aspirations. We are, and we always strive and endeavor to be a smart organization, and with our people and all of us working smartly. Smart means to us speed, working for more with less, being adaptable, being responsible, and being tech savvy. From a physical sense, today, as of end of June 2016, we had 93 branches and a proprietary ATM network of 135 ATMs. Now, I say proprietary because the entire ATM network of this country is today open to our customers in every nook and cranny of this country because we are part of the Lanka Pay network. We today have over 500,000 customers, and as of the first half of, at the end of the first half of 2016, we had an asset book of 193 billion and a capital base of 15.7 billion. Going back as to our progress in the last 4.5 years, we have consistently maintained an ROE which is better than the industry. If you look at our loan book and the products we have, you can see that we are very well balanced. This part of our products refer to products which are predominantly to the business segments of this country, which are the SMEs and the corporate. And the top part is really our consumer and leasing products that we have. So there is a very good balance, and we are growing the business products as we move forward. In terms of revenue, yes, we are still having a bit of skew from revenue generation from our consumer customer segment. That is because historically and traditionally we've been a very consumer-driven bank. But if you look at the other segments, we are moving forward in really aggressively growing those segments and bringing a balance to the revenue generation and the revenue streams from the different customer segments where the business customers are concerned. If you look at our volume growth, our asset book has been growing at a CAGR of 17% in the last 3.5 years compared to the market of 14. So we have been able to maintain our growth above the market. Moving now to the first half strategic activities that we have done against the backdrop of what has been also happening in the country and our key strategies. Just to recap, 1 year ago, I stood here and explained to the investors or to our investor forum that there were certain strategic pillars that we have focused on. The top of our pyramid, at the top of our pyramid, always is our customer. The customer is at the core of our business, core of our operations. It has been so historically, it is so now, and it will remain so in the future. We also recognize that customer centricity means different things at different points in history. And this is always evolving based on the external environment. So in 2015, when we looked at how do we deliver this customer centricity, we identified 4 key pillars that were imperative in terms of bringing that customer centricity. That was data analytics, digital, lean transformation, and our people. Data analytics, because we believe that the world is moving in a manner that together with digital, we are able to now convert our organization into a data-driven organization where our decision-making and our customer intimacy will be based on the data that we have. So we started that initiative at the beginning of 2015, and this is taking hold to converting our organization into a data-driven organization. I'll talk a little bit more about that later. Digital is a strategy that we implemented nearly 3 years ago, and we have had, let's say, a lot of pots simmering in this space, and we have launched some of that at the beginning of 2016 in the first half. The lean transformation is yet again something I have spoken about in our investor forums for the last 3 years, this being the 3rd year. And again, I'm really happy to say that this has now become a part of our culture and part of our DNA. Again, I will talk a little bit more about that later. And one of the most important pillars that the strategic pillars is the upgradation of skills and knowledge of our people. We recognize that as the environment changes very rapidly, we have to upgrade our people to be able to be successful in such a rapidly changing environment. So this has been one of our key strategic pillars as well. So let me now take you a little bit into the external environment in which we operated to set the context, the external environment in the country. So the key has been inflation. We have seen that inflation year on year has increased from 2.8 to 6% from December to June. The key factors here are food inflation and possibly because of the natural causes of floods and so on, as well as the fact that the VAT component in the healthcare sector and the telecommunications have also contributed to this uptick in a fairly steep rise in inflation, especially in the last 3 months of the first half. Now, where the regulator is concerned, this is obviously something that they are looking at very keenly and want to manage. But if you look at the credit growth, also in 2015, the inflation coupled with the credit growth, which was around 20% private sector credit, most of which came from the consumer sector, has made the regulator be a little concerned about that credit growth and inflation. And they have allowed that interest rate to go up, and has also done a policy rate increase in February. Actually, there was another policy rate increase in July as well, 50 BPS during February and 50 BPS in July. So we saw interest rates going up very, very sharply in terms of our cost of funds and our fixed deposits. The average weighted fixed deposit rate moved from 7.57 in December to 8.64 in June. That's over 100 basis points, and it's very, very steep for 6 months. The exchange rate was fairly stable, about a 2% depreciation. In terms of credit, what was the reaction of credit to the interest rate increase? We have numbers only up to May. You can see that it has tapered down slightly compared to the first 5 months of last year. It was 6%, 5.5 in the first 5 months of this year. Now we know the regulator is watching this very, very closely and will react if they see credit growth expanding beyond their expectations of about 17 to 18% for the year. Traditionally, the second half of the year always sees much steeper growth in credit than the first half. So we will have to see how credit growth reacts. Obviously, there are some liquidity constraints also in the market. So most probably this will bring down the demand for credit. On the import-export side, both imports and exports contracted in the first 6 months, 3% of imports and 6% on the export side. What were the challenges we faced against the backdrop of this? There were 2 key challenges that Nations Trust faced, the biggest being the sharp drop in our net interest margins. There was a 66 basis point drop compared to the first half of last year. Now, there are 2 reasons for this. One is there is a natural drop in our NIM. As we grow as a bank and as our loan book grows, you saw that even our products and our customer segments, consciously we are growing the SME and the corporate books. This is in line with our strategy. It is in line with the country's strategy and the country's demand. So when you move from being heavily skewed on a consumer book towards more stable SME and corporate type of business, you will naturally see there's a natural drop in the names because of that mix changing. But beyond that, we faced a significant challenge in the first 6 months due to the sharp increase in interest rates and therefore our cost of funds. Our book is such that 30% of our assets are in leasing and credit cards, both of which we are unable to reprice despite the cost going up. Now, credit cards has an interest rate ceiling of 24%, and we cannot increase the rates, and this 24% was brought when interest rates were very much lower than what it is now. The leasing, of course, it's by nature, leasing is a fixed product. So because of these 2 elements, we are unable to do anything about the pricing on those products. The balance 70%, there has been a lag in us repricing our clients as fast as the cost went up. Practically, when cost is rising very, very fast, it is very difficult practically to go to the market and continuously keep repricing our customers. So there's always a lag that happens. Of course, it has tapered now, and we see stability in our margins because those repricing cycles have happened. But this is what hit us in the first 6 months of the year. Added to that, in terms of our low-cost funds in CASA, naturally when interest rates rise, the low cost in any bank tends to stagnate or grow very, very at a very, very low level. So our CASA growth is in line with the industry, but nevertheless, we have not been able to mobilize to the extent that we would have wished in order to manage our cost of funds. So naturally, that also has impacted our margins. So this has been, in fact, the biggest challenge that we have faced in the first 6 months of this year that has impacted our performance. The second challenge has been the swap book that we have. Now, Nations Trust funds about 10% of our funding comes from foreign currency funds that we have that have been swapped into rupees. There's a reason why we do this, because overall there's a benefit to the bank. We managed to mobilize funding at between about 0.75 to 1% less than the normal cost of funds that come from fixed deposits. So naturally we use swaps to fund ourselves, and that's about 10%. But there is a downside to that in the short term. The downside is the second leg of that swap, we have to market based on forward premiums. So this first 6 months, we have got impacted by the movement in forward premiums, which have brought a higher swap cost to us as a result of that swap book that we have. So these are short-term fluctuations, and contract-wise, they even out at the end when it matures. And overall, eventually the benefit is there in terms of the net interest income or the funding, the cost of funds, but it hits us in the short term. So these are the 2 biggest factors that impacted us in the first 6 months of the year. So everything is not doom and gloom. We have done good things too. Our asset book has grown by 6% against an industry of about 5.5, against credit growth of about 5.5 to 5 in the first 6 months. Our fee-based income, our core fee-based income in foreign exchange, customer foreign exchange, and trade has done very well because we put a lot of focus in the first 6 months to this. We went out there to our trade hubs to really mobilize trade transactions, which generate not only trade fees, but generate the FX income. So we've seen traction on that, and we've done very well. And I'll show you the numbers a little later. The third aspect of managing our P&L was really about looking at very consciously the variable costs that are within our control directly in the short term, which also tend to grow with volume. So we've taken things like printing and stationery, communication, travel, overtime, and really worked on these cost lines. And I'm really happy to say that in most of these cost lines, we've actually managed to reduce the cost compared to the first 6 months of last year. So we've done that well as well. Let me now move on to the financials. These are the highlights. So revenue up by 2%. Again, the main reason for this limited growth in revenue is because the NII got impacted, and this was the biggest challenge we faced. And obviously the swap cost, which is represented under fees, under IFRS, also had an impact. Our core revenue actually grew by 13%, our core fees. But because of the swap cost coming in, this reduced to 4%. Operating expenses, 13%, looks steep, but I will explain what that is because we front-loaded some of the costs. Impairment charges show a huge dip here on the face of it, 55%. There's a reason for this. This is because last year, in the first 6 months, we took nearly 380 million in impairment as a one-off, which was due to the credit fraud that we had in the bank. So if you take that element out and compare the two halves, 2015 and 2016, actually our core impairment reduced by 7%, which is still fairly very good. The 55% is as a result of that one-off last year. So taking all this into consideration, our PBT tempered at 5% growth, and because our effective tax rate went up, PAT for the first 6 months compared to the first 6 months of last year was only 2%. Let me get into the detail. If you look at our volumes and NIM, this is, as I said, the biggest challenge we face. If you look at the volume growth that we had, which is the volume of assets and liabilities we did, the growth, the incremental growth we had in the first 6 months, it brought in about 1.2 billion in interest income and costs of 530. So we've got 674 million growth in NII coming as a result of our incremental volumes we've done in the first 6 months. But that got literally wiped out by the fact that our cost of our existing liabilities, the increase in costs versus the increase in our yields in the assets, on the asset side, were much lower, and there was a lag. So this negative 611 million literally wiped out the good work we did in terms of bringing the volumes and the additional NII. But what's pertinent to note is if you really look at the spread, which is here, the blue line, that in the last 2 or 3 months, because the asset lag was now being resolved and the pricing, the repricing was happening with clients, our margins have tapered up, and we expect some stability in our margins going forward. On the fee-based income, as I mentioned, our core fees improved by 13%, predominantly coming from trade and foreign exchange income, customer foreign exchange. This is not trading income. This is customer foreign exchange, improved by 24% compared to the previous year, and our trade in a declining trade volumes in the country. Despite that, we've increased our trade volumes because we have aggressively gone after trade customers in the particular trade hubs and increased our trade commissions by 8% compared to last year. But it was negated by the swap cost, the additional swap cost coming in, which is represented under fees because of our swap book. One key reason is because our swap book grew by 43% compared to the first half of last year. It was a much bigger book. And obviously, the rate movements, exchange rate forward premiums have impacted the mark to market, which has brought further cost. So this is why we eventually show only a 4% growth in our fees. In terms of operational cost, this 13% in operational cost is related to front-loading marketing, front-loading training and development compared to the first 6 months of last year, and AMC. Our core banking system, which we implemented at the end of 2014, really the depreciation on that, and the AMC started, really from, we started taking it from the second half of last year, not in the first half, and we have seen the first half for this year. When compared to the last year, the AMCs have gone up. In terms of marketing and training, it is much higher. We've invested in those in the first half of this year, much higher than last year. If you look at the other expenses, which are not marketing, training, or AMC related, those went up by 9%. As I mentioned, some of the controllable variable costs we've done very well. In fact, actually seeing a drop in the actual rupee expenses compared to last year, because we've handled that quite well, and we will continue to do that. In terms of impairment, as I explained, the core impairment is a drop of 7%. This is predominantly coming from the collections. We've done very, very well in terms of our leasing book, leasing and SME. We've seen good collection traction, and the bucket movements have been controlled in the leasing and SME portfolios. We also started looking at strengthening our collections by bringing scorecards to collections and looking at prioritizing by looking at customer behavior. So this is again related to data and data analytics in the collection front, where we are doing some prediction of which customers in which portfolios can lead to stress. And we have now started that process, and we will sort of take that forward and do more and more of data analytics in our collections division as we go forward. Thank you very much.